Yeah, now live.
Okay, well, good morning everybody and welcome to this meeting of the Shropshire County Pension Fund. Welcome to this meeting. I'm obliged to inform you that this meeting is being live streamed and recorded. Members of the public will be able to view the meeting using the link on the agenda. Our first item is apologies and substitutions, and we've received an apology from Councillor Carolyn Healy, and there isn't a substitute for Carolyn today. Item 2, disclosable interests. Do members have any disclosable pecuniary interests to make? No, thank you very much. We'll move on to minutes of the previous meeting. This was the meeting held on the 16th of September 2022. Can I have a proposer to accept these, please? Simon, and a seconder? Roger? Okay, thank you very much. Everybody else in favour? Yeah. Thank you very much. We'll now move on to public questions. This is item 4, and we've received 5 public questions. We have one questioner in person. The other 4 questions, Peter Chadderton, our pensions investment and responsible investment manager, will read out questions, and Justin Bridges, head of pensions, LGPS senior officer, will respond. So we will move on to the first question, which Peter, will you kindly read out? And this question is from Jamie Russell.
Thank you, Chair. So the question from Jamie Russell is, at the last pension fund committee, there was robust discussion amongst members about the possibility of divesting from coal mining giant Glencore. The company has recently been in the news. It is facing legal challenge in Australia over issuing misleading net zero climate claims. Meanwhile, it has recently been fined a record $281 million by a UK court for endemic bribery of African oil officials. Will the Pension Fund Committee now divest from this company as a response to its actions, or does the fact that Glencore remains hugely profitable for the fund outweigh concerns over its environmental and ethical record?
Thank you. And a response, please, Justin.
Thank you, Chair. The response is the decision to invest in Glencore is taken by the fund's external managers based on their analysis of the company's sector and economic environment. They are required to integrate environmental, social and governance considerations into their investment processes, and these considerations will impact the evaluation of a company where they are considered financially material. The company's share price will trade at a discount to its fair value when markets consider these ESG factors to be material. LGPS Central, Legal and General, Columbia Threadneedle Investments and LAPFF are engaging with companies across sectors, including mining companies, to accelerate the transition to a lower carbon economy on the fund's behalf. Engagement with Glencore, LGPS Central, along with other Climate Action 100 investors mentioned above, encourage the company to bring forward their coal exit plans in line with objectives set at COP26 in Paris. We take some encouragement from Glencore's decision taken in 2020 to set a net zero ambition by 2050, and their decision to put a climate transition plan to a vote at the 2021 AGM and future AGMs. Glencore's plan covers absolute emissions across all scopes, which was the first in the sector. Following engagement, Glencore strengthened its medium-term 2035 decarbonisation target from the 40% reduction to a 50% reduction. Following the 2021 AGM, Glencore also set a specific short-term target of a 15% reduction in absolute emissions by 2026. LGPS Central voted against Glencore's climate transition plan at the 2022 AGM. They have written to the firm to explain their decision and their ongoing concerns that the company's transition plan, and in particular its coal exit plan, is not Paris aligned in the short and medium term. LGPS Central engages with Glencore through the Climate Action 100, and investors will continue to put pressure on the company to accelerate its transition. However, focusing on the supply of fossil fuels is only part of the story. Whilst demand remains robust, and in the absence of coherent government policies to accelerate the transition into renewable energy, it seems likely that reserves will continue to be extracted and burned, if not done by listed companies, then by private entities. There seems to be little benefit to be derived from Glencore selling their coal assets or exploration rights to others to exploit. Coal remains an important part of the energy mix in many regions, and we are conscious of the hardship that can be associated with a spike in energy prices caused by a sudden contraction in supply. We are also cognizant of the importance of a just and managed transition away from fossil fuels. The deployment of supercritical power plant technology, carbon capture utilisation and storage, and carbon offsetting are also likely to play a part in emissions abatement, and it's important that companies like Glencore play their part in the development and deployment of these technologies. The transition to a lower carbon economy needs to accelerate rapidly, but we do not consider that divesting will help accelerate the transition. It is important that companies like Glencore are owned by engaged, responsible, long-term investors who are prepared to hold management to account on these issues. It is important to note Glencore is a key supplier of copper, cobalt, and other raw materials that are necessary for a low-carbon transition, and we believe that the firm will play a key part in this transition as it makes a withdrawal from thermal coal. In May 2022, Glencore resolved outstanding bribery cases in the US, UK, and Brazil. Our investment managers have carried out engagements with the company since these investigations first became public. There has been an overhaul of the senior management team at Glencore, and new management has made compliance a top-tier priority. The fund managers are of a view that the culture of the company has also improved significantly, and as such, the risk of these issues recurring is low. Overall, they consider the new management has properly and sufficiently focused on issues that could impact Glencore's licence to do business, such as compliance and safety. Glencore increased its transparency in the area by publishing its first ethics and compliance report, as well as its 2021 payments and governance report, which aligns with the reporting requirements of Chapter 10 of the EU Accounting Directive. Our managers have provided assurances that they will continue to monitor the situation as the company continues to strengthen its internal processes and culture. Improved environmental, social and governance controls can have a positive impact on the market's perception of the company and its management of risk, which can be positive in terms of the share price. We remain positive about the ability of investors to influence corporate behaviour in a positive way to encourage sustainability across a variety of environmental, social and governance factors. This can bring benefits to a broad set of stakeholders. Health and safety performance is improved across Glencore's assets, and investor scrutiny has contributed to the company's and other mining companies' commitment to improve in this area.
Thank you. And question 2 is from Chris Welsh.
Thank you, Chair. And Chris's question is the fund committed to keeping within 1.5 degrees Celsius or to 2 degrees Celsius or 3 degrees Celsius of global heating? If the fund does not have a commitment to limiting global heating, please state this.
And the response, please.
Check. The fund is committed to achieving net zero by 2050, in line with the aspirations of the UK government and the objectives set at COP26 in Paris, and the Institutional Investor Group on Climate Change, IIGCC Net Zero Framework. This is aligned with the ambition to limit global warming to 1.5 degrees.
Thank you. And our next question is from Joanna Blackman, who is here in person. So, Joanna, if you kindly join us at the table, please. Thank you. If you please like to ask your question.
Okay, so on
the 27th of October this year, the UN Environment Programme announced that there is now no credible pathway to 1.5 degrees in place, and warned that the world was likely to miss this target with catastrophic consequences. Does the Pension Fund Committee see the death of 1.5C as a sign that its policy of engagement has failed?
Thank you. And response, please.
Chair. There can be little doubt that urgent action is required if 1.5 degrees is to remain within reach. Whilst responsible investment has a role to play in the transition required, there are a number of other factors which play an important role. Responsible corporate ownership is important, and we need more investors to embrace their stewardship responsibility and to take a long-term view. However, it is critically important that we don't focus alone on the supply of fossil fuels. Attention also needs to be focused on the demand side of the challenge. If demand for fossil fuels remains robust, it is likely supply will continue to satisfy that demand. A comprehensive shift in the real economy is required, and the policy environment supporting this needs to be implemented. Responsible investors, through engagement with corporations, governments and government agencies, can make a valuable contribution, but investors acting alone cannot bring about the transition required. We consider that divesting from fossil fuel companies and heavy emitters will not help to bring about a more rapid transition.
Okay, thank you. And the next question 4, is from Sal Mager.
Thank you, Chair. Sal's question was, as a pension fund member, it is very important to me that the fund makes a rapid transition to net zero. Please could you outline and provide me with a copy of the fund's roadmap to get to net zero?
And the response, please.
The fund has set a net zero by 2050 target in line with the Institutional Investors Group on Climate Change, IIGCC Net Zero Framework, and in line with the UK government's aspirations and the target set at COP26 in Paris. This requires a 50% reduction in the finance emissions of the fund's equity, fixed income and real estate assets by 2030. A critical element to achieving these reductions is engagement with the companies in our portfolio that are responsible for the carbon emissions associated with our investments, and through that we can encourage the decarbonisation of the real economy. Divesting from companies involves selling those shares to other investors, which is a transfer of ownership from one investor to another. This in itself does not result in a reduction of real world emissions. The fund has developed a climate strategy and stewardship plan, which provides further details and can be found on the fund's website.
Thank you. And the 5th and final question is from Isabel Russell.
Thank you, Chair. And Isabel's question is, I am 15 and I am worried about my future. The news from COP27 was very scary. We were told that time is running out to cut emissions, but instead of acting, the UK government is issuing new oil and gas licences to companies like BP and Shell, companies that Shropshire Council Pension Fund invests in. The Internal Energy Agency and 99% of the world's scientists say drilling for new fossil fuels will break the 1.5 Celsius limit and could cause the collapse of civilization. Does the pension fund have a legal obligation to safeguard my future and that of other young people in Shropshire?
Thank you. And the response, please.
Chair, the UK government and other governments around the world have a critical role to play in introducing policies that drive the transition to a low carbon economy. This transition needs to accelerate if we are to limit global warming to 1.5 degrees. At this difficult time, energy security concerns and energy prices are also an important consideration for governments. The fund believes that responsible investors have a role to play in encouraging companies to decarbonise, to invest in the transition and to take a long-term view of climate risk management. Transition to a low-carbon economy is complex, and the pathway to net zero is unlikely to be linear. Companies such as Shell and BP will need to play their part in the transition, developing and deploying low-carbon technologies and supplying the low-carbon energy of the future. Our investment managers integrate environmental, social and governance considerations into their investment processes in order to manage these risks appropriately and in order to ensure that the investment returns required by the fund are achieved. They are also required to undertake stewardship activities such as engaging with the management of the companies in which they invest and voting at their annual general meetings. The funds managers are also engaging with governments around climate change and the implementation of the UK government's net zero strategy. We consider that stewardship has an important role to play in accelerating the transition. The fund and its climate change strategy also endeavours to take a holistic approach to manage climate change risk and to act in a manner that will enable broader transitions towards a low carbon economy through a combination of portfolio construction, engagement and policy advocacy.
Thank you very much. We'll now move on to.
Can I just ask a question?
No, no,
Oh, okay.
you can't. We'll now move on to item 5, the actuarial valuation and funding strategy statement update. And Mark Wilson, who's present with us from Mercer, will present us with this item. Over to you, please, Mark.
Thank you, Chair. Can you all see the slide? Sorry.
Yeah, it's in the packs of papers. Yeah, they're all in there.
Okay.
Yeah.
If we start on slide 3 then, which will just give us a overview of what we're looking at today. I'll just say I'm Mark Wilson, I'm the fund actuary. I work for Mercer, been involved with the fund for 16 years. So today we're going to do some valuation and funding strategy discussions and recap. Firstly, we're going to look back to the training we did earlier in the year. Then we'll take a look at the 2019 valuation and what's happened since then, the key changes. Then we'll look at the funding strategy statement for 2022, the key fund policies that will apply going forward. Then we'll cover the 2022 valuation results. And finally, we'll finish with a run through on what the fund is doing around employer risk. There'll be plenty of time for questions at the end, hopefully. But if you do have any questions, then feel free to ask them as I go along.
Just going to say we're on about page 40 of the pack.
So if we move on to the slide that's now headed Valuation Training Recap. So this is what we covered earlier in the year, and it's worth just drawing out the key points, so we know where we're starting from. So firstly, why do we do a valuation? It's a legislative requirement, but it's worth looking at what the regulations actually say. Firstly, there's a requirement to secure the solvency of the pension fund in the long term, and there's also a requirement to achieve cost efficiency in the long term, which we interpret as keeping contributions as stable as we reasonably can. Beyond that, there's a good reason to do regular valuations. The fund is a very long-term proposition, 80 years or more, so it makes sense to check in regularly, make small adjustments as needed, and avoid a situation where we check in less frequently. The adjustments we then have to make are bigger to achieve our long-term goals, and the impact on employees in terms of contribution stability is bigger. So it's good practice to do a valuation regularly. In terms of the inputs to the valuation, we take in pretty much everything. So we take in the individual member data for all fund members. That's a very important part of it, of course. The quality of the results is only as good as the quality of the data. I know that the fund does a lot of work in that area. Also, it's worth noting that where we don't have good data, we as actuaries have to make assumptions. Because we're actuaries, we're naturally prudent. And so poor data will actually result in employers paying higher contributions. So it's very important to engage on these issues and make sure you've got good quality data. We also take all the fund's investment and asset information, asset values, investment strategy, cash flows, and that feeds into the work. We then come up with a funding strategy, which lays out the fund's policies and rules for operating the valuation and the following 3 years. And then we make various key assumptions to get down to some actual balance sheet and contribution figures. Outcomes of the valuation, we have a balance sheet, assets, liabilities, surplus, deficit. We have future service contributions to cover new benefits being earned every day by the members. We also have deficit contributions or surplus offsets to remove any deficit or surplus over a reasonable period. Important to remember, we do this at fund level, but we also do it for every employer in the fund. There's not really any cross subsidies. Every employer is responsible for their own position, and those positions can vary quite a lot employer to employer. I've highlighted some of the key assumptions there. By far and away, the most important one is the discount rate or the future investment return, the inflation assumption, CPI, and in particular, the difference between the two. All the fund's liabilities are linked to CPI directly or indirectly, mostly directly. So what happens is if you get returns above CPI, then you are getting a gain. Some of those returns can be used to fund benefits and contributions can be lower. So the higher that assumption is, investment return relative to inflation, the lower contributions are and the better the funding position is, and vice versa. The other key assumption is life expectancy. That one's fairly obvious. The longer people live, the more expensive the pension fund is, and vice versa. I've included salary increases briefly. This is an assumption that it's important, but it probably gets more focused than it really warrants. Only a increasingly small percentage of the overall benefits are linked to final salary now. So while employers in particular will focus in on that, its impact is increasingly limited. So if we move on to the next section, the 2019 valuation review. 2019, it was a good valuation. It was a positive valuation compared to the previous 3 years. The funding level had gone from 84% to 94%, and the deficit had more than halved, down to 130 million. This came through in the contributions. Employers currently are paying 16.6% of pay in respect of new benefits being earned, £9 million to recover the deficit, which works out at about 3.5% of pay. So on average, employers are currently paying just over 20% of pay into the fund. Now that's on average. There's a lot of variety employer to employer, and that chart in the bottom right shows that. So on the left-hand side, you've got the funding position of the employers, and across the bottom, you've got the total contributions that they pay. Now, at the one extreme, there's an employer paying almost 35% of pay. At the other extreme, there's a couple of employers paying zero, although they're slightly odd cases, but there's other employers paying 10, 15%. And that highlights the fact that you can get massively different experience between different employers. And there's a few things that would drive that. Age of the membership drives the future service rate, and that can make big differences there. It's more expensive to provide benefits for older members because you can't invest their money for as long, so you don't get as much investment return. The size of the employer and their profile can affect the funding position quite a lot. So the key point there is you get a lot of variety employer to employer. On the next slide, we can see how the fund has progressed since 2019. So we started off at 2019, 94% funded. Things went pretty well for the best part of a year. We got over 100% funded briefly. Then COVID happened. The fund fell quite quickly. It fell to 78% funded at one point, so a pretty huge fall. It's probably worth noting that that was before the last valuation was signed off, before the last set of contributions was agreed. Now, we didn't make any changes to the contributions for this. We felt that it was still appropriate to keep the long-term plan that we had in place. That proved to be a good thing because the fund recovered quite quickly, as did markets generally. And 12 months later, the fund was actually 104% funded. Over the last year to the valuation date, the fund improved further, and at one point it was almost 115% funded on the old assumptions. But then higher inflation started to kick in, started to drive liability values up. We also saw the impact of the war in Ukraine weighing on asset values. By the time we got to the valuation date, on the old assumptions, we were around about 101% funded. So we've been higher at various points, but it was still overall a very positive outcome. As those arrows on the right indicate, a lot of variation employer to employer. One particular point to note on that, a lot of this improvement is driven by good investment performance. So what you'll find is that the employers who were better funded in 2019 will benefit from that more. They had more assets last time, so they benefit more from the investment returns. So you get a situation to some degree where the best funded employers in 2019 are getting even better funding positions at this valuation, whereas the worst funded employers at the last valuation won't benefit as much, and in some cases might see reduced positions. So you might see that spread amongst different employers getting larger. So moving on to the next slide, one part of the 2022 valuation was to look at the fund's experience in terms of demographics. The biggest part of this is mortality experience, and it's worth splitting that into two parts: COVID experience and then the general trends that we're seeing beyond COVID. So I'll cover COVID first, and I'll do that with apologies to anyone who was personally affected. I know it can be a difficult subject for some, but it is important that we cover it because it is something we're asked a lot in terms of the pension fund. What was the fund experience and what's the impact of COVID? So we looked at this in some detail last year, and what we found over the 2 years from 2019 to 21 was that the fund experienced about 35% more deaths than we might have expected based on the assumptions. So quite a significant number of additional deaths. However, if you drill into the numbers more, what we found is that those deaths were very much amongst the oldest members of the fund. And so while the impact in terms of number of lives was large, the impact on the actual funding position was quite small. because they were the older members, they had the smallest liabilities, and so the impact was less than it would have been if it had been younger members. So in terms of impact on the funding level, it improved it by somewhat less than 0.5%. So the actual impact on anyone's contributions because of COVID at this valuation will be quite minor. The other aspect of COVID is what will be the impact going forward, and that's a harder question. We're seeing now some limited evidence of higher death rates or a negative impact on life expectancy. The reasons for that possibly not directly COVID related, but other issues around NHS backlogs, missed cancer diagnoses, that sort of things. It's worth saying though, there are other views on this as well, and there are views that ultimately life expectancy might be improved because of COVID, because of increased health awareness, increased investment in health, kind of developments that will ultimately have longer term benefits. The short answer is though, we don't really know what the long-term impact is going to be yet. And so for this valuation, we're just staying on the course that we are. We're not making a specific long-term adjustment. So if we look at the wider life expectancy, after we strip out the impact of COVID, what we've found is that improvements in life expectancy over the last few years have slowed versus what was assumed at the last valuation and versus previous trends. This is a nationwide thing. It's not specific to Shropshire. It's something that's emerging from a lot of valuations. The net impact of that is you get a gain on your funding position. So it reduces your liabilities by around 2% and it knocks just over 0.5% off your future service rate. And that's a benefit that'll come through at this valuation for all of the employers to some degree. We looked at other aspects of demographics. The only one really worth touching on is commutation. Now, when members retire, they can swap pension for a lump sum. The LGPS regulations dictate that for every pound you give up, you get £12 of lump sum. Now, those aren't particularly great terms. When we do the valuation, we put a figure closer to maybe £20 on it. So what that means is every pound that gets commuted, the pension fund and the relevant employer effectively gains £8. Now, what we've found over the last few years is that rates of commutation have been slowing. We don't know exactly why. It may be people wising up to the fact that the terms aren't that great. It might be people more worried about their long-term life expectancy. They think they might live longer, and so they don't want to give up that pension for a short-term gain. Whatever the ultimate cause, we're seeing some impact on the funding level. It's going to drive liabilities up a little bit because we're not getting as much gains coming through, and it'll also have an impact on the future service rate. So in combination, the impact of the demographics, it's going to reduce liabilities by just under 2%, so a 2% funding level gain, and it'll have a minor impact on the future service rate as well. So finally in this section, I'll just talk briefly about inflation, which is very topical at the minute. It's very important to the fund. As I mentioned before, all of the fund's liabilities are linked to CPI directly or indirectly, mostly directly. We now know what the next pension increase is going to be. 1st of April 23, all of the pensions in the fund will go up by 10.1%. So at a stroke, all of the fund's benefit payments for the next 80 years go up by 10.1%, which obviously has a fairly huge impact. In isolation, that might maybe knock 7% off your funding level, let's say. So it's obviously, it's a pretty huge impact. Now, as far as this valuation goes, all this is factored in. While the inflation is high currently, it's also known and expected, and we've built it in. We have good results even allowing for that. The issue is, and the potential risk, is what if inflation stays higher for longer than we've assumed? And in particular, what if that then weighs on your asset performance as well? Because you have a recession, your assets aren't returning as much, and so you get a situation where your liabilities are increasing very quickly, more than you've allowed for, while your assets are flat or worse. And so you're getting a gap that's widening between your assets and liabilities, and it can very quickly take large chunks out of your funding level. So the position can move quite quickly. It's important to bear that in mind because high inflation of 10% is not a problem in and of itself for the fund if your investments are returning 12, 13%. But if inflation is 10% and you're only returning 5%, then you're losing 5% effectively of your funding level. And so the two things to take away from this, firstly, just the impact that inflation can have and the fund's exposure to it. And also just to note that it is built in so far. And so the pension increase next year, it's not going to impact on any of the results you see today. The risk is more if we see inflation stick around at higher levels for longer than we've assumed. So I'll move on now to the funding strategy statement. To the slide that's headed key assumption changes since 2019. It's worth just running through some of these now. Firstly, the discount rate, and we'll consider that alongside inflation. There's a few things going on here. The expected returns are up in absolute terms, so the discount rates in absolute terms have increased. A couple of things going on there, including the work you've done around your investment strategy, which according to our models is going to increase the expected returns going forward, which is a positive. Against that, expected inflation is obviously up from 2.4% to 3.1%, so that's going to eat into your real returns. I should say the 3.1% is a long-term average, so that does allow for much higher inflation in the short term before tailing off to a lower, more historically reasonable assumption in the longer term. So the net impact is that we've reduced the real discount rates above inflation by 0.15%, and that's going to have a small impact on all of the employees in the fund in terms of slightly reduced funding levels and slightly increased future service contribution rates. There's some separate lower risk discount rates there. I'm going to come on to those separately in the section on employer risk. And I'll also cover the ill health captive there as well, which we'll get into. The other points to note here, life expectancy we've covered. The main other one is McLeod. You'll be aware of the McLeod judgment and the issues that's thrown up. At the last valuation, all the employers were informed of the potential McLeod costs, but they weren't built into the results. Employers could pay them if they wanted to, but they weren't forced to. At this valuation, because McLeod is now pretty well known and understood, it's going to be built into everyone's liabilities automatically. There's no impact on future service because the cut-off date, the end date for McLeod is the valuation date, so it'll just come through automatically in all employers' liabilities. So if we go on to the next slide and the wider funding parameters, from the funding strategy statement. Firstly, recovery periods for recovering any deficit or surplus are being reduced by 3 years. So effectively what we're doing is we're maintaining the long-term target date, aim to remove deficit or surplus by a certain date. We're 3 years on, so we reduce the period by 3 years. Probably worth noting, we might not do that forever. You do reach a point where a really short recovery period becomes quite impractical, because if the recovery period's short, then your contributions get very volatile. And when you're trying to keep contributions stable, it has the opposite effect. It also has the problem of what do you do when you get to time zero? If you start a new 30-year recovery period, do you just make people pay off the surplus every year? So when it gets short, it doesn't work. And so at some point, we'll probably look at that. We're not there yet because currently the recovery period is 16 years. Maybe once we get to kind of 12, 10, we might start to think about not bringing that down anymore and make it more of a smoothing period for smoothing out fluctuations rather than recovering deficits and surpluses. But for now, it's coming down by 3 years. Another point to just be aware of, and I'll cover this more later, but any employee who has a termination deficit, as certain do, so if they left the fund, they would have to pay the fund some money. If they have an ongoing funding surplus, they can't use that surplus to offset their contributions, which is a fairly standard thing for the LGPS. Point 3 is worth noting. The contributions we set are a minimum. Employers can choose to pay more if they want to. Why would they do that? In most cases, they wouldn't, but there are some very well-funded employers whose contributions are going to be very low, maybe 2-3% of pay in some cases. And what that's made up of is contributions for new benefits of 20%, but then a big surplus offset of 17-18%. Now, the issue that comes with that is if you're taking back a lot of your surplus very quickly, once it's gone, it's going to go faster. And then once it's disappeared, you have a very big increase. You go from 3% to 20%, for example. So some employers in that position might choose to pay more to make the surplus last longer and to reduce the increase as and when it's gone. It's not something the fund is going to force anyone to do, but it's something that we've asked some employers to bear in mind and just think about. A couple of other things. The fund will offer the prepayment option again, so employers can prepay their contributions early in return for a discount based on the expected returns they might get. Also, for any employers facing a contribution increase at this valuation, there won't be an increase in the first year, so they'll be able to keep the contributions steady over 2023-24. Then the increases will kick in the next year, and there'll be option to do some further phasing there, just for those employers who do have a set of results that requires them to pay more, just to help them manage budgets, and so that doesn't hit them all in one go. So I feel like that was a lot of preamble. So if we move on to the whole fund results slide, it's labelled slide 14. These are the valuation results. So on the left-hand side, we have the 2019 results. Briefly, a deficit of 130 million, a funding level of 94%, and employees currently paying 20.1% of pay, 16.6 for new benefits, plus another 3.5 for deficit. So we move on 3 years, and the position is very positive. And I realise some of the things I've said up to now were quite cautionary, but it is worth bearing in mind that this is a very good set of valuation results. It's very positive. So your deficit is pretty much gone. It's down to 10 million. You're effectively 100% funded. Primary contributions for future service are up a little bit. Partly assumption changes, partly change in profile. The fund's gotten a little older, so benefits have gotten a little bit more expensive. But those deficit contributions now are pretty much gone. So instead of 20.1% in total, contributions are coming down by almost 2% on average. I say again, a lot of variation employer by employer, but at whole fund level and for many employers, it's going to be a very positive set of results, hopefully, where the contributions they pay into the fund are going to reduce. And on the right-hand side, I just want to illustrate this. This is something we showed to the employers when we did the employer presentation. It's not in any way our best estimate of what will happen, but it is a risk that's worth bearing in mind. Essentially what we're doing is a very simple illustration. What if we had higher inflation and that did weigh on growth? And on average, that cost us 0.25% a year going forward in terms of real investment returns. You can see that it would very quickly eradicate all your gains on the funding side. So you go back down to about 95% funded. Future service contributions would be up. And instead of looking at a 2% reduction in contributions, we'd be looking at a 2% increase. Again, this is just to really illustrate to the employers the issues that the fund are dealing with and considering when they're making the long-term plan and the risks that they have to consider. But that notwithstanding, a very good set of results. On the next slide, I just wanted to touch briefly on post-valuation experience. A couple of points there. Obviously, a lot's changed since the last valuation. We've had 2 prime ministers, I don't know, 18 chancellors, I've lost count. But we're in a very different position now, and it's just worth thinking about the impact of that. So to the end of October, the fund's assets were down about 6%. Common to many funds, it's been a challenging investment environment, and a lot of funds are down, and Shropshire's no exception. Also, we've had very high inflation, 7.8% March to October, so equivalent to about 14% a year. So if we're just to roll forward the funding position in a very mechanical way, what you'd find the impact of those 2 factors will be to take the funding level from 100% down to 90% or less. So it's a big chunk. Now, in practice, if we're actually doing the valuation today, we wouldn't be certifying 90% funding level. Because what you'd find is that, in particular the inflation side, while the inflation experience has been very high, you'd have an opposite effect in your inflation assumption, because that would get lower because 6 months of very high inflation has worked its way out of the assumption. And so you'd be able to justify a higher real discount rate, which would offset a lot of that. So I think the takeaways from this are 2. Firstly, it illustrates, again, I've made this point a few times, but the potential impact of very high inflation. Also, that while the post-valuation experience has been quite volatile, ultimately, I think if we were doing the valuation today, I can't say exactly what the funding level might be, but the important thing is I think we'd still be very comfortable certifying the same contributions that we've put forward. And I think that's the important point, because the key output of all the valuation work is essentially the employer contributions. They're the hard outcome of all this. And I think in spite of everything that's happened, we can be comfortable that the rates we're certifying for employers are still appropriate. So I'm just going to cover now employer risk a little bit. This is something the fund has done some work on over the last year or so. It's probably worth just thinking first, what are we talking about here when we're talking about employer risk? So the fund as a whole is made up of many employers. Most of those employers have taxpayer backing directly or indirectly, but around 10% of the fund don't. So what happens is, at some point, those employers will likely leave the fund, or many of them will. Now, when they leave, essentially their liabilities, responsibility for making sure the benefits to their former members get paid falls to all the other employees in the fund. So what the fund does when they leave is they do a final assessment, and they do that using more cautious assumptions so that you get a suitable exit payment from the outgoing employer such that it leaves a buffer of assets to protect the other employers. It leaves a reasonable margin so that other employers that stay in the fund don't end up paying for the benefits of another employer. So when we talk about employer risk, ultimately the risk is that an employer leaves the fund, can't make that payment, you don't have enough asset cover left, and so other employers in the fund, mainly the councils essentially, end up pitching in to pay the benefits of other employers. So it's a risk that's identified, and the fund has to certainly consider how to manage it. So what are the options here? The first option is to do nothing. You could just say it's a risk we're happy to live with. The issue there is it does leave the fund exposed to criticism that it's not managing this risk properly and it's not protecting the other employers. So it's something that needs to consider, and most funds are on the side of doing something. Excuse me. Another option would be to just focus on the highest risk employers. That's certainly a valid approach, and it's part of the overall strategy for the fund. But as part of this, there has to be some acknowledgement that even the strongest private sector employer, they can't match the strength or the covenant of a taxpayer backing. The councils effectively, they can't not pay these benefits in effect. So they have that taxpayer backing that makes them 100% guaranteed from the fund's perspective. Even the strongest private sector employer can't match that. We think it's appropriate that there's some recognition of that in the funding strategy and the way we deal with different employers. Question we get asked is, why are we doing this now? Why are we addressing this now? Well, firstly, it's something that a lot of funds have already done. A good chunk of funds moved to doing something on this in 2019 or even before. The funds that aren't doing something, we're expecting to either do something or strongly consider it as part of this valuation. It's also something that the Government Actuaries Department are focusing on quite closely, expecting funds to do more around managing these risks, because they make a very good point, actually, that what we're seeing is the pension fund is essentially growing faster than the employers that support it. So the absolute size of the risk relative to the payroll, relative to the funding that backs it, is getting bigger and bigger. So risk management is becoming more important. So having said all that, what form should we do? What form should we take to address this risk? Essentially, there are a couple of different options. The first is you get employers to provide a bond. So they put some insurance policy in place that effectively guarantees that termination debt will be covered as and when it falls due. The second is you have the employers pay higher contributions, so they gradually improve their funding position and the risk you're exposed to gradually reduces. Which brings us nicely onto the proposed funding approach on the next slide. Essentially, you can see here what we're proposing. In the table, the left-hand side is what taxpayer-backed employers will do, how they'll be treated. And for the other employers, the ones that don't have that backing, they'll essentially be given a choice. So they can provide some sort of bond to cover their termination debt, in which case they'll get treatment largely in line with that of a council or an academy. Some slight differences, mainly around the recovery of surplus using surplus offsets, but essentially the same sort of treatment as a council. The other option is they essentially pay higher contributions. We set the contributions using lower discount rate assumptions. We take 0.25% off the funding level discount rate assumption and 0.5% off the future service. That results in higher contributions. They pay more in, and so gradually that risk is being reduced by higher contributions. So that will be the policy. These employees have all been contacted, they've all seen the results, and they'll all make a choice about which approach they'd like to take. And where there are going to be increases, and there certainly will be for some of these employers, they'll again be able to phase those increases in over a few years. So unless there's any immediate concerns, and I don't think there are for any of the employers we're talking about, by and large, they'll be able to phase in those increases over time. Finally, a comparison with other funds, just to give you a little bit of comfort on this, because I know everyone likes to know what other funds are doing and make sure you're not out on a limb or being unfair to your employers versus what's being done elsewhere. There's a summary of what's going on in some of the other funds. Essentially, as part of this, I sat down and I went through the funding strategy statement and the contribution rates of about half of the funds, the bigger half, so the ones that are more in common with Shropshire. And what I found is that generally, for the employers we're looking at, current contributions from the 2019 valuation, Shropshire's at the lower end. Generally, your treatment of these employers is more generous than most. I didn't really find any funds that treat them more generously currently. And so I don't think there's any concern that by introducing this policy, we're going to be coming out of line with other employers, other funds, excuse me. You can see some examples in the red boxes. I won't go through them all. These are some funds that are doing similar things. Everyone has their own different approach. They do it in a slightly different way, but everything adds up to the same bottom line. It's higher contributions if you don't have some security in place. And in some cases, even if you do, there's quite a variation, excuse me, around how far these policies go, but they all amount to something similar, higher contributions. I'll just finish up with a last slide around the ill health captive, which is something we're introducing from the 1st of April. Ill health costs in the fund can be very high. If you have the wrong member retiring in ill health, you can have additional costs occur as a one-off stroke of a pen, £500,000, even £1 million in some cases. If you have a young member retire, they get a very large benefit and health enhancements. Instead of paying contributions of £5,000 in 20 years, all of a sudden you're paying benefits of £20,000 from today. And it can have a huge impact, particularly on smaller employers, where it can take them from a very healthy position to all of a sudden they have massive deficits and massive contributions. It can have a real impact. So what the fund's doing is it's introducing a captive, effectively an internal insurance arrangement. What will happen for these smaller employers in the fund? It's effectively employers with 200 active members or less. They'll all be pooled for ill health experience. They'll pay money into a captive insurance arrangement within the fund. That at each valuation will then fund everyone's ill health costs. So essentially, instead of paying your own costs, you pay a proportionate share of the captive. And so that experience becomes a lot smoother and more manageable. And so you don't get the potential for these huge one-off hits in funding level and in contributions. So it's just a good way to manage the risk for smaller employers. And I've seen it done in other funds, and it's very popular. We never have any employers complain about it. It's normally the opposite way. The employers who don't qualify would like to get in, but it's an easy way to manage a potentially costly risk. So finally, just briefly, the next steps. So we've just had the employer forums and the employer one-to-one. So all the employers have now had the results. They've been told about these funding strategy changes. They've had a chance to speak to the actuaries, myself and Michelle, about their own results. And so they'll now be considering them, considering any options they have. And then earlier in the new year, we'll be confirming contributions. Also, the employer consultation will be going on. They'll have a chance to see the strategy, have a comment on it, feedback. In Q1, the fund will consider those consultation responses. Contributions will be confirmed, and then we'll be signing off the final results and the final report in March 2023. And the whole thing is finalised by 31 March 2023, which is the final cut-off date. So that's all from me. Are there any questions?
Yes, Brian. I've got a couple of questions, I think. Can I take members to page 11 of the report? Page 11 of the report. The mortality and life expectancy. It's taking everybody a long time to get to page 11.
Page 49.
Well,
I found page 11.
page 11 of Appendix A. I don't quite know.
I've got it.
Well,
What was the slide header? Sorry.
well, mortality and life expectancy, democratic assumptions.
Oh, right. Yeah. So slide 8.
Slide 8.
So I don't have the full pack. I've only got the slide deck.
Page 49 of the actual full pack, or page 11 on
I
your
still
slide.
understand this because mine says page 21 of the full pack and page 11 of the report. Well, actuarially, that doesn't seem to. Anyway, going on to more concerning matters. I have just discovered that at the age of 88, as I am now, I am actuarially dead.
It's okay.
believed it.
But
It's
to go
okay,
to a serious point, this table, which I wanted you to look at, is showing that male and female life expectancy has fallen between 2019 and 2022. Your report seems to assume an increase in life expectancy. Are we then saying that this is a blip between 2019 and 2022 that shows a fall in life expectancy, and whereas you appear to be basing your assumptions on an increase in life expectancy?
So what it is, it's not that life expectancy has fallen. It's that at the last valuation, we made an assumption about how it would increase. And while life expectancy has increased, it's not increased as much as we assumed. So life expectancy is still increasing, but the rate of increase has slowed versus what we assumed.
Oh, well, the table is headed male life expectancy 65, 2019 23.1, 2022 22.1. It didn't give the impression that was an assumption. It gave an impression that that was a fact.
I don't think I've got the page you've got. Sorry, I'm not.
Right, fine, okay. So the answer is that life expectancy is still increasing.
Yes, yes, on average for the fund. There has been a little bit of rebalancing between the different groups. So I think pensioner life expectancy has probably taken the biggest adjustment. And so it's possible that pensioner life expectancy might have come down. But overall for the fund, including the actives and deferred, in total life expectancy is still improving and assumed to improve, but not quite as much as was built into the last assumptions.
Okay, thank you.
No problem.
Feel better now.
Yes, Roger. Thank you, Chairman. I don't know how to
I've got another
explain
year.
this. As on the report before the slides start, on page 16 of our pack, or page 6 of this report, it says that risk management strategy, and then afterwards it says, note this section is subject to finalisation following the upcoming strategy review. And then the next section says climate change, and there's a note by the side of it. Note this section is subject to finalisation once the guidance has been provided. Can you confirm what these mean?
Yeah, sure. For the first one, I understand that you're reviewing your investment strategy in February. So what goes into the final funding strategy statement will be your final long-term investment strategy, whatever is agreed. So for a minute, that's just a placeholder. Once you've been through that process in February, when we finalise the FSS in March, the final strategy will go in there. For the second one on climate change, the Government Actuaries Department is going to issue guidance as to what has to go into FSSs and valuation reports around climate change reporting, and it's going to be fairly prescriptive. So we're still waiting for the final guidance. So until we have that, we can't finalise what goes in there. So again, for the minute, that's just a placeholder until we know exactly what's required.
Through you, Chairman, when you say finally prescriptive,
yeah,
does that mean that the government may change the whole game that we're playing? Can I use that word?
No, to be very clear, it's not prescriptive in terms of how you invest. It's just we'll be required to show certain things around illustrating how the funding level might change under different scenarios. So it might be, for example, if we move to 1.5% very quickly, if we move to 1.5% in a more orderly transition, if we don't hit 1.5% at all, and we'd be required to show how the funding level might change under those different scenarios. But we're still waiting for those scenarios to be confirmed. So we don't know exactly what's going to go in there yet. Ultimately, they're quite keen for the guidance to be fairly prescriptive so you can have fair comparisons between different funds. So currently we're still waiting on the guidance, but that's guidance for how you address it in the strategy statement and how it goes into the valuation report. It's not going to be guidance about how you actually deal with climate change or how you invest.
Last time,
Yep.
Chairman,
Yep.
But it could affect, could have some very significant underlying effects. Do we have any dates of when this may be intimated it may happen?
I don't have firm dates yet, but it will have to be fairly soon because once they have the scenarios, we then have to go away and do the calculations. So I'd be disappointed if we don't have something firm on this by the end of the year.
Okay, any other questions? Yes, Ray.
Mark, thank you for a really good presentation. It's very helpful. I've twice been on the receiving end or the joining end of the council's pension, well, one council's pension and one in the West Midlands, where we've had a cheaper transfer. I was sure we had to take out bonds. Have I made that up?
Yeah, there is a fund policy around that, yes, that when a new employer joins, that I think the norm is to put a bond in place. That's probably slightly different in most cases, because when we talk about the employer risk, we're talking about the employers who don't have a guarantor in the fund. So they would tend to be colleges and universities, they would be housing bodies, and then potentially small charity type bodies or bodies that do community work. When we're talking about the bonds, that's probably more common for outsourcings. So contractors performing works for councils such as yourself. And in that case, the bond is slightly different in that it's more there to protect the guarantor. Whereas when we're talking about the employer risk, we're talking about protecting the fund generally, where there is no guarantor.
It's a different bond.
Yeah, it is a different bond. It's ultimately a part of the same thing in that it's dealing with the risk posed by employers, but it's very different risk if you do and don't have a guarantor in the fund.
Any other questions?
If I could have another one. I don't know where I'm taking you now. It appears to be your page. I'm on the comparison with other funds, which is page 19 of.
I think that's the slides.
Huh?
I think that's the slides.
Yeah, slide 19.
All right, yeah, fine, whatever.
Yeah.
I'm slightly concerned about the note relating to our fund. It's the third bullet point. We aren't aware of any LGPS funds that currently have a more generous combined approach to non-taxpayer backed employers than SCPF, our fund. Yeah. Do we have the same financial responsibility to non-taxpayer backed employers? My impression is that our principal purpose is to look after the retirement benefits, the pension benefits of those employed in our two councils, mainly Shropshire and Telford and Wrekin, and other local government employers. Do we really want to be more generous towards non-taxpayer backed employers?
Well, that's essentially what the policy is doing. It's putting some protections in place. But the way the fund works, ultimately, there's a lot of employers in there, but ultimately, it's all underwritten effectively by the two councils. If all the employers, unlikely of course, but if all the other employers were to leave, it would all effectively collapse back to the two councils. And so when we talk about protecting employers and putting an employer risk policy in place to protect against the employers that don't have taxpayer backing, and so where there is more risk, it's essentially the two councils are the biggest two employers. They would take on the biggest chunk, so they're getting the most protection. And so what this risk policy is about, it is making, I wouldn't have phrased it like this, but it is making it less generous in effect. And it is increasing the protection offered to the other employers, principally the two councils.
Increasing the protection to the two councils?
Yes. So essentially we're saying that our approach is currently, as far as I'm aware, as generous as any fund. And so we're making it a little bit, again, I don't like using the phrase less generous because it creates the wrong impression, but a little bit more cautious, if you like.
Yes, okay. I got the impression that we are treating the employees of non-taxpayer backed employers more generously than we are treating our own employees.
No, it's not employees at all.
That's not implied by this.
Employees' benefits are defined by the regulations, so everyone gets the same based on their own circumstances and pay. It's the same rules for everyone. This is just about employers and effectively what they ultimately pay into the fund, but it doesn't have any impact at all on employees.
Okay.
Yes, Simon.
Sorry, Brian.
If I could ask one final question. There's a reference in the main report, key funding principles, to guarantors.
Yes.
Do we have any guarantors?
Yes. A lot of employers in the fund have a guarantor. So if, for example, the council outsources a particular cleaning contract to a private employer, the members transfer to that private employer. They're entitled to keep their pension provision, and so that employer becomes an employer in the fund. So they get admitted to the fund and they become one of the fund employers. Now, when that happens, the council automatically acts as guarantor to that employer. And what happens is as and when that employer eventually leaves, the council will take responsibility for all the benefits. They'll take it back in-house. So yes, there are various guarantors in the fund. In most cases, it's the two councils, because you're the biggest part of the fund. And so most of the contracts relate to you in some way or other.
All right. They're not, it's not like getting a bond for a contract or something.
No, it's not. It's not that employers approach other employers and ask if they can be guarantor generally. It happens automatically. An employer is admitted because they've been admitted effectively by another employer at council as part of a contract. And so you automatically become the guarantor.
Okay, thank you. Thank you.
Simon.
Yeah, it's a very quick one, really. It's excuse me. You mentioned that the employees benefit from 20% of their pay going into the pension pot on average across. Has it always been around 20%, or is this something that, because of the structure that we've got, that it's CPI based, it's just crept up and crept up and crept up?
It's probably varied quite a bit over the years. It probably doesn't. I don't think it's ever been too far from 20%. I think it's probably been coming down for the last couple of years as the funding position has improved. Essentially, and I can only go back as far as my career, but when I joined in 2006, funding levels were quite low, and funds weren't in such good shape. So at that point, they were paying deficit contributions. They were trying to recover quite a large deficit over quite a long period. And so the deficit contributions were quite high. So back then they were probably paying a little more. Against that, the assumptions maybe weren't quite as high, but probably a little bit more than now on average. And then I would say over maybe the last 10 years, it's probably come down a little bit. The deficit contributions have been paid, and so funding positions have got better. The fund's investments have performed well, so deficits have been reduced because of that. And so gradually, I think contributions have come down a little bit. And then at this valuation again, they're coming down by a couple of % more.
And would that be standard across the public sector?
It's fairly standard across the LGPS. There's a reasonable amount of variation, but yeah, I think something a bit below 20% for a council is fairly typical. And for a fund as a whole, yeah, 20% is reasonable, maybe slightly lower than average. Across the wider private sector, it's probably a little bit lower. For example, I think the number in the teachers fund is 23.4. But the LGPS is very different to the rest of the public sector, which is largely unfunded, whereas as the LGPS is funded, so the dynamic there is quite different. Principally, you have assets whereas the others don't. And so if your assets perform well, and generally over the last few years they have performed well, you can benefit from that in the way that an unfunded scheme can't, because they haven't invested any money. So they haven't got any investment returns as such.
Oh, thanks, that's quick. Thank you.
Thanks very much. Thank you, Mark, very much indeed. A really interesting report. And the one thing that's I flagged up is the effects of inflation,
Yes.
which really is absolutely crucial. We will be returning to, we've got a recommendation actually in paper 15 later on in the meeting that covers this and the next two items. So we'll be coming back to this a little bit later on. So thank you, Mark, and we'll move on to item 6.
If I can just echo what Ray said, it was a very fine presentation, a very clear presentation. I don't know how you managed to keep going without much more frequent liquid lubrication, but thank you very much indeed.
Thank you. Appreciate that.
I know they are here. I'm not quite sure what the delay is.
Because it just disappeared for a while.
In the meantime, I forgot to mention this at the beginning. I'm anticipating that we have a break for 5 to 10 minutes, probably just after item 11.
Let's have a break now while we're.
Yeah, okay.
I don't think I can wait till after. It's me age, you know.
Brian. Look at all the meetings. Last time dead. Morning. Morning.
we'll resume in just a minute or so. Of our members will be back in a very short period of time. Is that what they've got? Yeah, so that's what it doesn't matter. They will have it.
We can still have a break after 11 if you like.
Yes, please.
You're granting permission, are you?
Oh,
Okay, well,
suggesting-
moving on to item 6,
Thank you.
climate risk report. I'd just like to welcome colleagues from LGPS Central, Patrick O'Hara and Matthew Jones, we know well. And I'd also like to particularly welcome on this occasion Bazia Salah and Jack Young, who are also here today. And the two sections, we'll take one at a time. There's the first one is the climate risk report, and then the second item is the task force for climate related financial disclosures. So we'll start off, please, with the climate risk report, and welcome to you all.
Right, well, just say thank you for inviting us again this morning. Good to see you, Councillor Biggins and councillors, members of the committee. So yeah, I think Jack's going to take us through that, this first report. So without further ado, I'll just hand over to Jack and the team to talk us through it.
Okay, thank you very much, Matt. Thank you very much, everyone, for the opportunity to present this. We'll start with the presentation. So this is the presentation on the 2022 Climate Risk Report prepared for Shropshire County Pension Fund, prepared by LGPS Central. My name is Jack Young. I'm a junior responsible investments and engagement analyst. I joined LGPS Central 2 months ago, and as you said, we're with Basha Saleh, the RINE manager, and Patrick, the RINE director. So if we move on to the second slide, I trust you've all got versions of the presentation in front of you. What's the purpose of this presentation? Basically, we're looking to support the publication of the 2022 Climate Risk Report. We want to highlight the report's key findings and provide an overview of basically the fund's progress in managing climate risk. This is the third version of the Climate Risk Report, and we're going to very much follow the structure of the report in this presentation. We're going to look at metrics and targets, we're going to look at strategy, and we're going to look at climate stewardship. This is also based very much on the structure of the TCFD, and in fact the purpose of the Climate Risk Report is to give you all of the points of the TCFD and then a little bit more detail as well. You can think of it as a sort of TCFD plus. In this presentation, there will be an update from Patrick as well, who's going to give you a little bit more information on the recent consultation for the TCFD. And then we'll finish with a conclusion. So if we move on to slide.
Just let me just check that councillors are on the same page in terms of the presentation.
Page 100 of the pack, page 2 of the presentation.
My apologies, I don't have that pack.
No,
So.
Got it then.
Right, yeah.
So we're on the slide now titled Shropshire County Pension Fund, and you should see a breakdown of what goes into the fund and what we look at in the climate risk report, as well as a few metrics on the left. Is everyone caught up? That's working.
No, I'm afraid not. Which what's the pack number?
Page 100.
Page
100, isn't it?
101 now.
Sorry.
So that's 17.
And the presentation number is page 3.
Well, well, it might be one advantage of that. Unusual.
And yeah, just to summarise, so this presentation is a summary of the wider, deeper report that you've got in the pack. So that's what we'll go through.
Okay, so looking at this slide titled Shropshire County Pension Fund, for the purposes of the climate risk report, we look at total equities only. This is for a couple of reasons. It's basically due to where the quality of the data is best available. For other asset classes, it's still not quite there yet. And this is something we're working with the data providers to try and increase, to try and better. But for now, we're just looking at passive equities and active equities, and you can see the breakdown on the slide in front of you. We're going to touch on a few different metrics throughout this presentation. The first one, we can see the portfolio carbon intensity. This is a really important and really useful metric. Carbon intensity is basically calculated by looking at the carbon footprint, the absolute emissions of a company, but then dividing that by sales. And what that does is allows for a really good comparison of company by company in order to look at the amount that they're emitting and their overall impact on the climate. And what we do then is we take the weighted average of this. So it's not just divided by the size of the company, but also by the company's presence in the portfolio. And that allows for a really good comparison between different funds and really taking into consideration the size of the investment that we have as well. The second metric, it's a little bit easier to understand and a little bit easier to explain. This is the exposure to clean tech and fossil fuel reserves. This is expressed simply in a percentage, and it refers to the weight of the portfolio which is invested in companies who are either, or whose products include clean tech, or they own fossil fuel reserves, a simple percentage. The final metric is a new one for this year's report. And it's a really useful one and a really powerful metric. It's financed emissions, and it's expressed in tons of carbon dioxide equivalent. This is an absolute metric. So we're just looking at the amount of carbon emissions that your investment is responsible for. So this is looking at the investor holding as a proportion of the overall company, and then timesing that by the emissions of that company. So when we're looking at the emissions of the portfolio, this is really useful. We can now move on to the next slide, and we're getting into the depths of the metrics and targets section here. This is a slide on the portfolio's carbon intensity. And well, before I go into what's going on here, we can see data from 2022 from this year and 2020. 2020 is chosen as the baseline because it's when we started collecting data. And we're going to continue comparing to that baseline as we move forwards. And we can see both of these bars, both of these charts, we have really positive progress. The carbon intensity of both the total equities portfolio and the benchmark at which to which we compare it have decreased massively by almost 50% between 2020 and 2022. Now, this has been driven by Shropshire's decision to reallocate a good proportion of its funds. These have been shifted, the legal and general funds have been shifted to a low carbon transition fund, and some other funds have been transitioned to a global sustainable equities fund, bringing about this 46% decrease in the total equities. So that's a really promising and encouraging figure. We can see that the benchmark has also gone down. This is a result of how we calculate the benchmark. So the benchmark we use is comprised of benchmarks similar to the portfolios that we're invested in, but then it's re-weighted to ensure that it's as accurate as possible to the portfolios and the investments that we have. So it makes sense that the portfolio benchmark has also gone down, but it's really encouraging, and I would draw your attention to both the fact that in 2020 and in 2022, the carbon intensity was less than that of the benchmark. So it's a really great bit of information there. We can move on to the next slide, and we can see financed emissions. This is the metric I told you about just now, really carbon focused. And again, we have another really dramatic decrease here, almost 50% again. Most of this shift has come from the shift in funds through the legal and general funds, but the global sustainable equities has also made a nice difference as well. And we're dropping from just over 50,000 to 30,000. Really positive and really encouraging. If we move on to the next slide, we can see the top 5 contributors. And these are the top 5 contributors to companies that are contributing to the carbon footprint, the carbon intensity metric, as well as the financed emissions. There are 10 companies, 2 top 5s, but actually just 7 companies due to repetitions in both of those lists. Now, this figure has changed quite a lot since the last climate risk report because a lot of the funds have been reallocated. So this is really the purpose of this report, to show you how the carbon impact, the climate impact is changing as we shift the allocation. And we can see here we've got NextEra, Holcim, Linde, RWE and CF Industries topping the carbon intensity contributions, and RWE, Holcim, CRH, CF Industries and Glencore in the biggest contributions to the financed emissions as well. So because of these changes, there are a few companies which are not currently present in the climate stewardship plan. I'll talk a bit more about that in more detail soon, but it's really important to note here that every company which is not currently present in the plan has been recommended as an addition to the plan going forwards. And again, this is exactly the purpose of this report, to draw your attention to this kind of changing scene and changing dynamics. We can now move on to the next metric, the simplest metric, the weight in clean tech and fossil fuel reserves. Now, the key takeaway here is that each one of these metrics has moved in a really positive direction. We can see an increase in companies which have some kind of weight in clean technology, and a really significant decrease in companies who have some weight in fossil fuel reserves. In fact, almost a 50% decrease in companies which have a weight in fossil fuel reserves. It wasn't very high in 2020, and it's even lower in 2022. The table just below, now we're looking at net zero targets of all of the different companies that we invest in. Now, these are taken from a sort of gathering of 3 different sources. We look at MSCI, CA100+, and Carbon Disclosure Project, and we look at how many and what proportion of the portfolio has net zero targets according to those 3 sources. We can see over 50% of the total equities, currently do have net zero pledges. For companies in the material sectors, this goes up to almost 54%. And the really encouraging, and I think the most important statistic here, is that almost 80% of the financed emissions generated by a portfolio come from companies who also have a net zero target. This shows that the direction, presuming these targets are followed, should continue to get better and better. And we are looking at improving this metric in coming years. And we've just taken out, or started working with Net Zero Zeal, who are basically offering a slightly more stringent look at the quality of these net zero targets. So that's something to look forward to in the coming reports. Moving on to the next slide, we're now moving into the strategy section of the report. So this is the climate scenario analysis, which is provided by Mercer. Before I go into too much detail about what's shown in this slide, let's just sort of start from the beginning and talk about what is a climate scenario analysis. Basically, what we're looking here is to estimate the effects of different climate scenarios and the impact of these scenarios on the risk and return within the portfolio. A good climate scenario analysis should facilitate strategic asset allocation as well as other investment decisions going forwards. How does this climate scenario analysis work in particular? It looks at short, medium and long-term risks. We can see the timeline starts in year 0, this is 2022, and goes on for the next 40 years. And it looks at transition risks and physical risks. So for those of you not familiar with those terms, transition risks are risks associated with climate change, but more associated with as society changes to adapt to the changing climate. So this could be the incorporation of things like carbon pricing or increase in clean technology all over the portfolio, changing consumer sort of demands as well will factor into this. On the other hand, we have physical risks. These are much more associated with the risks that we all think of when we think of climate change. This is the increase in temperature, this is the sea levels rising, and the increased probability of extreme weather events. So what Mercer does is they take all of the information in Shropshire's portfolio, they plug it into their system, and they come out with this projection and 4 key recommendations, which are tracked according to 3 different scenarios. This is quite important. The rapid transition. So this assumes that society transitions really quickly in order to mitigate climate change as much as possible. We see sudden divestment from a lot of traditional fossil fuel companies. There's lots of transition risks that this brings with it. Carbon pricing goes way up, but the physical risks are very much mitigated. On the other hand, we see the failed transition. In this scenario, there are no transition risks because society isn't transitioning. But as time goes on, we start to see increased physical risks from those elements that I mentioned before. There's also a third scenario, and this is represented by the orange line on that graph. And this is the orderly transition. And this is somewhere between the two. And it assumes an early transition, a smooth transition, not marked by sort of universal divestment, but fast adoption of reduced climate impact. So 4 conclusions that come from this scenario analysis, the second scenario analysis that Shropshire has carried out. The first conclusion, that a successful transition is imperative to ensure the maximisation of asset performance. This one relates very clearly to what we can see on the graph. Assets fare significantly better under the rapid and the orderly transition. It's really interesting to note here, it's a little bit hard to see in the graph, but in the failed transition, you will see a slight outperformance in the short term over the next 5 or so years. And this is because although we are starting to see increased physical risks, they're not quite coming into play, and because there's no transition risks, those companies do quite well. But as soon as we move into the medium and long-term horizon, the importance of the rapid and orderly transition comes clear. Moving on to the second key conclusion, sustainable allocations protect against transition risk, while growth assets are highly vulnerable to physical risk. What this is relating to is a significant variation in impact of the transition across the different asset classes. So it's really important to consider sustainable allocations to protect against this kind of transition risk. And that's exactly what we've seen this year with Shropshire's reallocation into the Global Sustainable Equity and Low Carbon Transition Funds. Moving on to key conclusion 3. It's really important to monitor sector and regional exposures. Of course, every sector and every region is impacted by these physical risks and the transition risks a little bit differently. This is perhaps most clear when we look at the sector differences, and sectors like oil and gas and the fossil fuel sectors, of course, fare quite poorly under the rapid and orderly transition scenarios, while renewables and clean tech perform really, really well. So it's important there to just be aware of all of these different elements and incorporate them into your investment decisions. The final conclusion here, key conclusion 4, to be aware of future pricing shocks. The key point here is that this is a projection. It's trying to tell the future, but no one really can tell the future. There are always going to be pricing shocks which can't be predicted from an early outset, especially. Pricing shocks have been priced in for the transition risks and the physical risks, as I mentioned before, but they will always be there. And that's why it's so important to keep in mind those other conclusions, to consider sector allocation, regional allocation, and asset classes as well.
Can I just clarify something, Jack?
Sure.
On the orderly and disorderly scenarios there is assumption that the government and governments around the world implement policies that drive the transition to 1.5 and 1.6 degrees. It's not a divestment driven scenario, it's a government policy driven scenario. And that's why it's an orderly and disorderly one that has more coherent policy implementation from governments around the world, while it's less so, more rushed and more rapid. They're both are clearly better than the failed scenario where we do nothing, but they are, an integral assumption is that they have a policy framework associated with them to bring about transition.
Chairman, I don't want to interrupt the thing, but I notice you've got a 40-year projection on that. That's 2062. Why not 2050? Why not a 30-year projection? Because that's what we're heading to, isn't it? 1.5, or even a 2025, 2030, something like that. To do a 40-year projection is way beyond where I want to be.
It's a great question. I think, though, one of the real benefits with this analysis is that it covers every year from now until 40 years. So if you want to focus particularly on what's going to happen in 2050, you can choose your own time frame within that projection. So it offers you that insight all the way along the road until 2062, as you say, but not disregarding other elements along that road. Does that answer your question?
If I can, Chairman, it shows increasing whatever. I would have hoped that by 2050 we are in a decreasing situation as far as climate change and the rate and the trying to reduce the temperature 1.5 maximum and then maybe trying to come down. But it seems to be conclusion successful transition is imperative. Yes, it is, but the transition imperative is by 2050. I'm not looking at 40. I'm looking at that coming down. So that's why I question, through you, Chairman, the 40-year projection shouldn't be there. The 40-year projection should be something very, very different to what a 30-year projection is, to me.
I mean, I think it's important to remember that, actually, if you're coming on this, that these are scenarios rather than predictions or models as to how we will get to 1.5 degrees and the net zero ambitions that we've agreed here and that we're all working towards. They are this is a slightly different purpose to this analysis.
Well, what you don't really see on this chart is there's a baseline line, that's a black line, which is the baseline right behind the yellow line. That's basically the long-term expected return of the portfolio. And the yellow, green and red lines isolates the climate impact to the portfolio based on different scenarios. So the reason why it's stretched to 40 years is simply to show you that the physical impact does not stop at 2050, continues on even long term.
So let's go on, yeah.
Great. I'm sure there'll be plenty more time for further questions if you have any at the end as well.
Sorry, Jack. It's worth noting in the report that you have in the pack, there's a lot more information that will give you a bit more clarity on how they come up with all these conclusions. There's a lot more visualization, especially on sector and regional exposure. I thought those charts are quite useful for the pension committee to look at. And the purpose of it is to just keep in mind that these risks are there going forward. So when we make investment decisions,
strategic asset allocation decisions, you need to be aware of all these risks in the portfolio.
And I think as well, the failed scenario is the assumption that, the policy implementation doesn't happen. And therefore we don't hit the net zero targets of 2050. And that requires a modelling out beyond 2050 to fully understand what the implications of that would be beyond 2050 as well.
Thanks.
Okay. So if we move then on to the next slide, this is slide 9 on my packet. I'm not sure what it is for you, but it's a slide titled Climate Stewardship Plan. I alluded to this a little bit earlier. This plan is basically there to identify a focus list of companies for prioritised engagement. And these companies are engaged by the fund's portfolio managers and suppliers on behalf of the fund. Now, this is done often through manager monitoring meetings, as well as our quarterly reviews. And a lot of the engagements are carried out by Climate Action 100 Plus, the logo that you can see on the slide. This is an investor-led initiative, for those of you who aren't familiar with it, whereby investors around the world really collaborate in order to engage with the major emitters. The idea being that if these investors can come together, their voice is a little bit more powerful and a little bit more convincing in terms of driving that change that we want to see. The Transition Pathway Initiative also features in this part, and that's basically a body which provides data on corporate progress along the low carbon transition. If we move to the next slide, we'll see what the climate stewardship plan actually looks like. I'll talk you through a little bit about what we can see in the table, and then I'll give a couple of examples. First of all, the next 3 slides continue with the plan. There's 3 companies here, and more companies on the next slides. We can see the company in the left-hand column and the sector in which that company operates in the next one. The CA 100 Plus column, this is a pie chart showing how the company is doing in terms of its progress towards net zero according to Climate Action 100 Plus. They're quizzed, I suppose, or assessed on 10 different areas, 10 different actions. These actions include short, medium and long-term targets and whether or not the company has those, what it's doing in terms of capital alignment and so on. 10 different areas. Green is all elements are met. Yellow is some areas are met. Red is no areas are met, and grey is not assessed. You'll notice a lot of them have a grey element in the pie chart, and that's to do with the just transition, which is still in the beta phase at Climate Action 100 Plus. We can then see the strategy and engagement objectives. This is very much to do with how this company is engaged with and what's trying to be achieved through these engagements. The next columns are from TPI. We can see their management quality. This is on a scale of 0 to 4, and 4-star is one step beyond that. This is to do with to what extent the management in the company recognise climate change as an important issue and how it's sort of approached in terms of management quality. And then we have the TPI carbon performance, which is to what extent the company is aligned to net zero in the short, medium and long term. This could either be not aligned, it could be aligned to a 1.5 scenario, 2-degree scenario, or to national pledges in which the company operates. As promised, I'll talk through a couple of examples from this plan. I'm sure many of your eyes have jumped to Glencore. This is an investment that we're keeping very close eyes on. And actually, OGPS Central are a co-lead in the focus group at Climate Action 100 Plus. So we're very closely tied up with engagement efforts there. We are engaged with Glencore, and just to keep it entirely focused on climate for the purposes of this report and this presentation. First of all, there has been some progress from Glencore as a result of investor pressure over the last years. We can see that they brought out a pledge for net zero across all scopes of their emissions. That's direct and indirect scopes produced by the company, as well as emissions produced along the value chain, both upstream and downstream. It also has an absolute emission reduction target of 50% by 2035. This was improved from a 40% reduction, again, in part due to shareholder pressure. and a short-term reduction of 15% by 2026. It was actually the first company in its sector to announce short, medium, and long-term emission reduction targets across all scopes. In terms of looking forwards, it's also increasing its focus on mining materials which are really important for the green transition. We're talking about copper, nickel, and cobalt, amongst others. So there is progress from Glencore, and it's really important when we're considering the companies in which we invest that we see the potential for companies to better their approach towards climate change, and that's part of our reasoning behind it. That said, of course, there are lots of areas which still need to be improved, and this is why we're engaging with them. We recently voted against Glencore's climate plan in their 2022 AGM. We're pressing them for the adoption of more ambitious short-term targets, as well as increasing their transparency through their net zero accounting. Now, what's really interesting, some of you may be familiar with a case in Australia being brought by Client Earth and the Environmental Defenders Office, where they're taking Glencore to court for basically not doing enough regarding objectives which are quite similar to our objectives here. And I think the key takeaway is that every approach, every strategy here is really important in order to push Glencore towards adopting a more or a reduced climate impact, a strategy that reduces its climate impact. And that needs to happen in the courts, it needs to happen in the boardrooms, it needs to happen from the government legislative part as well. But the engagement is a really important part of that. And we have seen some really good improvements as a result of the investor engagement over the last few years. If we move on to the next slide, we have more companies in the climate stewardship plan. The table set up in exactly the same way. I'll talk you through Shell, if that's okay. Of course, one of the big oil majors, and actually another company which LGPS Central is involved in the focus group, Climate Action 100 Plus for. And again, it's a company which admittedly has a lot of work to be done, but is showing some progress in both its recognition of climate change as a material issue and in terms of trying to adapt its strategy to incorporate that. So far, again, in part due to investor engagement, Shell have come out with Scope 1 and 2 emission reduction targets to net zero, as well as a 65% reduction in Scope 3 emissions, all by 2050. LGPS Central and Climate Engagement push Shell to give the shareholders a vote on its climate plan to be able to tell the company whether or not we're happy with its plan or not. And this was another vote which LGPS Central decided to vote against. So looking forwards, there's a lot of work that still needs to be done with these companies. We're looking on focusing on including absolute emission reduction targets across all scopes. This is also Scope 3. This is also the upstream and the downstream emissions produced by Shell, as well as aligning capital expenditure with their net zero ambitions. Of course, with this engagement, it's not a set a goal, achieve it, and sit back and relax. It's a continuous process. We celebrate the progress when it comes, and we look towards future goals to keep pushing them forwards. Now, if we move on to the next slide, as I mentioned earlier, a lot of the makeup of the biggest contributors towards carbon footprints and financed emissions have changed as a result of the shift in the portfolio. And this slide is proposed additions. These are companies that we're recommending the fund to add to its climate stewardship plan in light of the changes in the portfolio. And we can see here RWE, CRH, Linde, and CF Industries. I'll go into a bit more detail here on RWE. This is a big energy company based in Germany. And again, it follows the line in some way of a lot of the other companies on this planet and the other companies in our portfolios, that it's a big contributor to financed emissions. It's the biggest contributor to financed emissions. It's the fourth biggest contributor to carbon footprint in the fund, but it's currently being engaged by CA 100 Plus. LGPS Central stewardship provider EOS is a co-lead as well, so it could lead to really easy integration into the climate stewardship plan. And RWE has set out really quite encouraging targets regarding climate change. It's looking to phase out coal by 2030. This is 8 years earlier than previously planned, again showing the weight of this kind of engagement. It's looking to invest 50 billion euros in green expansion. Included in this is a further gigawatt of renewable energy and 3 gigawatts of hydrogen power in Germany. So again, it's just really important that we are engaging with these companies who recognise climate change, who are starting to take action to mitigate those risks and to reduce its impact. And we're seeing progress. The next slide is on the TCFD consultation and Shropshire's work with this. And I think Patrick's going to take this one.
Yes, just to give you an update on the recent TCFD consultation that was done by the Department for Levelling Up, which was a follow-on from what the Department for Work and Pensions did last year in terms of expecting occupational pension schemes to now produce mandatory TCFD reports. The Department for Levelling Up is now pushing us into the local government pension area. As you're sure you're aware, you've been doing this for a few years now, so you're in a good position to start with compliance with the consultation. There are some new additional requirements that were in the consultation, which I'll flag. It's due to come. The consultation has ended now, 24th of November. We responded, and so did Shropshire. It's due to come into force in Q4 2024, so there is a bit of time to prepare and get ready for this. Some of the key changes, key differences to what you're doing now is that there will be a requirement to report emissions at scope 1, 2 and 3 level. So adding up your emissions across all of your different asset class exposures and reporting there. Now, as you know, scope 1 and 2 emissions are those emissions associated with the company's own operations, and scope 3 is emissions associated with their products in use. So for an automobile manufacturer, that's their cars in use, and their supply chain. So going back to the metal and the rubber and the raw materials that go into the manufacturing of those products. There's very little data around that reported at the moment. There is some modelled data out there. So that's going to be a challenge. There's a dearth of data. We're going to try and integrate scope 3 emissions into this report next year, and we're going to try and acquire some estimated data in order to be able to do that. Estimated data is not great, it's better than nothing. It'll give us some indication of the carbon footprint of the portfolio. There will be a requirement to produce scenario analysis based on 2 scenarios. We actually think 3 scenarios are better: disorderly, orderly, and a failed scenario. That's going to be a requirement. It's going to be a requirement to do that on the investment side, which we're currently doing, but also drive that into valuations and do scenario analysis on liability modelling. Again, that's a challenge, and I think the industry has got some catching up to do on that. Again, it's a data challenge in itself, but I think progress can be made. There will be mandatory targets, so you will have to set a target, but you will have jurisdiction over which targets you set. So it could be a coverage target in terms of how much of your assets are included in your report. It could be a carbon intensity target, or it could be an absolute emissions target. They do require, they call them administrative authorities, but we'll call them partner funds for ease of reference. There will be a requirement to produce carbon intensity and absolute emission numbers in your TCFD report going forward. And we think that's a good idea because they tell a slightly different story in terms of the performance and the trajectory of the fund. There will be a requirement to report to LGPS. So LGPS, the Scheme Advisory Board, will collect a report from all of the partner funds around the country and report on that. That could involve some collating of all those data into one report, which again provides some data challenges, but you know, it's doable. It's something that we can certainly help do. We can modify this report, and we are going to be looking at how we can make this report more intuitive and more helpful next year, and including some of these new TCFD consultation requirements in that, so to help you comply. Our feeling is that there's not enough reference in here to net zero, which is the target that many pools and partner funds are adopting. But overall, we think that Shropshire's in a good position to comply with this, showing leadership both within the pool and across asset owners generally in terms of the ambition of what you're hoping to achieve here, and also the level of reporting, the governance and the stewardship activities that you're putting in place around this. I was taking any questions either now or later.
So any questions, anybody? Yes, Lindsay.
First question I had was which is on. I'll press this one.
Left, yeah.
Yeah, okay. Right, well, the 43% drop in financed emissions is really great to hear. And could we carry on in that at that level, we could achieve net zero for us quite a bit earlier. But in we have to do training, which is absolutely welcomed, and in the fundamentals too. Edwin Whitehead of Reddington made a presentation, and I asked about the fact that we've had the largest emissions this year. The climate is undergoing such change, and I said, has engagement really worked? And he said no, and it was kind of like an industry secret that it hasn't worked, because if it had, we wouldn't be in this mess. So how does that add up with what you're saying? And also in your climate plan votes, what were the outcomes? You know, what's actually being achieved here? Because we see wildfires, we see 40 degrees in the UK, you know, we see flooding in Pakistan. You know, so how does that add up?
Well, what we're generally seeing in terms of the votes is that around 20% seems to be the mark where investors are voting against these transition plans and voting in support of shareholder resolutions that are climate orientated. Now, that used to be about 5 or 6%, maybe 2, 3, 4 years ago. So there is evidence to suggest that mainstream investors who wouldn't necessarily regard themselves as ethical investors or even responsible investors are recognising the importance of these issues and are prepared to encourage companies to move at an accelerated pace. And when you say has engagement worked, we wouldn't have had these transition plans on the ballot at the AGM if it wasn't investors asking for it. There's a chart that I can share with you around CA100, which measures commitments to net zero from the corporate world, and the chart is very flat. CA100 comes into effect in 2017. There's a couple of years where it goes up slightly, and then it's a hockey stick. Now, that's not saying the job is done, but there has significant progress has been made. Part of the challenge is that these companies' business models are still successful. There's still great demand for fossil fuels and coal. So there's only so much we as investors can do. We can't buck the trends in terms of how the economy is predicated and how it's fueled. We need government intervention to do that. We need greater subsidies for renewables. We need some of the externalities associated with the fossil fuel industry to be internalised, you know, a price on carbon, which we didn't even really see discussed at the last COP27 meeting in any detail, which was disappointing. So we are part of the solution, but we need other actors to also do their part. So when we say that has engagement worked, it has achieved a great deal. We talked about lobbying earlier, that companies are very secretive about the lobbying that they were doing around climate change. They would have a public position, and then the industry bodies that they were members of were sometimes lobbying in a different direction. Now they're required through engagement to publish lobbying reports and disclosure around that, which gives us an opportunity to challenge them. And Glencore left an organisation recently, I think it was the Australian Coal Commission or something along those lines, based on the fact that they couldn't get comfortable with the lobbying position that organisation was taking. So all of these things are part of the solution and part of the drive. And yes, there is a lot more work to do, but progress has been made. The challenge is but as I said, it's difficult for these companies to transition when there is great demand for the product they produce. The CEOs of Glencore, Shell, BP, they have a fiduciary responsibility to shareholders. So for them to shutter their assets and walk away from those sorts of profits leaves them exposed to litigation and legal action. If they were to sell their dirty assets to somebody else to operate, that's been done and that's feasible. That doesn't really help real world emissions go down. That makes their carbon footprint look better, and it might make our portfolios look better. But if those assets are operated by private equity or a local operator or government agency, those emissions still go up into the atmosphere, and the impact on the planet is minimal. It could even be negative if they're not as efficient in their operations and they're not reporting their emissions. So what we really need to see is a decarbonisation of these companies, not just a shift in the assets around the real economy and from one investor's portfolio to another. And as I said, that is a challenge in the current economic environment. We've seen the invasion of Ukraine cause an energy spike, and we've seen that that's exactly what happens if we see a cut in supply of energy without any associated cut in demand. We get an energy spike, and people who are least able to cope with that tend to suffer the most. So that's the kind of transition we're looking at here, is that reduction in fossil fuel use associated with an increase in renewable energy use. And it needs to be managed very carefully. If you look at Glencore, for example, Glencore has exposure to lithium, cobalt, nickel. All of these materials are essential for the transition to a low carbon economy. They're used in renewable energy, they're used in electric vehicles, and these companies are actually part of the solution. So their investment now in renewable energy and these products is an important part that's going to drive the transition to a lower carbon economy. So that's, I would say that we have to be realistic about what investor engagement can achieve, but progress is being made.
Okay, thank you very much. Yes, Roger.
Thank you, Chairman. In the climate stewardship plan, on those tables there, you've got us under the CA 100 plus, you've got this scenario there. Net extra, for example, 50% red. And under the things it says no criteria met. So you got TPI management quality 4 stars. What does that actually mean, please?
Which one?
Okay.
Go ahead.
All right. CA 100 and TPI are two different bodies, two different scoring metrics. CA 100 looks specifically at 10 scenarios, like Alex mentioned. It could be short, medium, long-term targets, CapEx, capital expenditure alignment to 1.5 degree scenario, just transition, and many others. It is TPI management quality is how the management incorporates climate change into their decision making. And the reason why CA 100 score for Nextera, for example, is 50% red is simply because they have not met these criteria. But they are, according to TPI, looking into it very closely. And Nextera is actually the largest renewable energy producer in the US. So it is a big part of the business. It's a company which are looking to transition very quickly to net zero. Part of it is to transition away from coal production to gas production. That's the first phase, and then the next phase is more renewables. So just because they have not met the CA 100 plus score just yet, does not mean that they are not looking into it very closely. And that's the reason probably why TPI score the management 4 star.
Well, it's an important point, and it comes back to the engagement point. It's quite easy for companies to make commitments, and get points for making commitments. It's quite easy for them to put out policies and frameworks. It's another thing implementing them and actually living by them. And it's one of our roles as the owners of those companies to hold the feet to the fire on these things and make sure they do make progress, which is why you have two metrics. What's the policy environment? What's the commitments look like? And then what is actually the performance doing in terms of decarbonisation? And quite often they don't live up to each other. And that's where we need to call it out and intervene.
If I can, Chair, but then if you go to the next three columns, not aligned, not aligned, not aligned. So is there a commitment or isn't there a commitment or not? Because it doesn't state so there in it.
Yeah, this is the thing. Again, it's easy to make a 2050 commitment, but that requires short-term targets.
But they haven't made anything. It says not aligned in any of those three columns. So is there a commitment there or isn't there?
There is a commitment by NextEra. The way TPI measures the carbon performance alignment is sector-based. So they have a base year of maybe 2010 or later, and it goes all the way down to 0 by 2050. Now, NextEra may not be aligned to this pathway because their baseline could be an earlier date, or it could just be that they aim to go net zero by 2051, 2052, 2055. So our job as investor is to make sure that they tighten this pledges to make sure they are more aligned to what is required.
So I'll come back, Chairman. They're a 4-star company, but they have not aligned with any of the targets.
So if I could jump in there, I think the point of these columns is they are referring to slightly different things. The management quality or the management quality rating is very much focused on what they're doing at board level in terms of the recognition of climate change. So to what extent they discuss climate change in the AGMs, to what extent there are people responsible for the climate impact and overlooking the climate impact. So normally you do see more alignment between the management quality and the carbon performance, but it is possible, and we can see it here with NextEra, where they're aware of climate change, they're discussing it, but they haven't yet taken out the targets or formalized the targets in such a way that it's aligned in the short, medium and long term. And this is why we include 3 different columns at the same time. Because it is such a difficult problem to really, truly and substantively assess a company's progress towards net zero, there's no real one knockout metric. So we have to look at CA 100+, we have to look at TPI's management quality, and we have to look at TPI's carbon performance. And we can make assumptions, I suppose, about which one of these columns is more important. And of course, in terms of general climate change impact, we really would want to see aligned targets in the short, medium and long term. We can be encouraged by the fact that they do have a good management quality rating and they are improving as well in CA 100+. I can't remember the figures exactly, but I think in the last assessment they were even more, there was more red, more yellow and less green. So, it is a coming together of all of these points. And when we're engaging with these companies, we do use all of this information in order to draw up our engagement objectives and our strategy in order to push them to achieving the kind of things that we all want them to achieve.
I think if you were to ask NextEra of their view on the TPI scores, they probably wouldn't agree with you. This is a very specific methodology here that Asha mentioned about the pathway alignment, and that's TPI's view of where they currently are in terms of their alignment. The company measuring themselves against their own targets would probably take a different view, but we actually use independent assessments of that as well as listen to what the companies have to say.
I think Jack mentioned the tools that we use. TPI is one of the CA100, obviously one of the measurements that we look at, but we also look at net zero zeal. So when we use all these tools, it's not just to score the companies, but it's also to pinpoint what to engage on. So, for example, the net zero zeal pinpoints exactly where the company fails when it comes to alignment to net zero. So when we go to the company next time at a meeting, we can simply go to them and pinpoint, you guys are not aligned when it comes to short-term targets or medium-term targets or long-term targets, whatever it is, where we think they need to improve. So it is a tool, it is a work in progress.
Final comment, Chairman. I can talk about it at a meeting about what we're going to do, but unless I say we're going to do it and there's a commitment, it's just talk. I'm sorry to be blunt, but to me, I've been at meetings where there's promises made and all sorts done, but the actual culmination of that meeting is just talk. And without a commitment, and it's a measurable commitment, it isn't there, and it says not aligned. So unless that commitment is there, it doesn't mean anything to me. Sorry, Chairman.
Yeah, okay. I'm conscious a little bit of time.
Yeah.
We are going to come back to climate risk reports in the exempt papers. How are we doing on this particular section? Are we almost there, do you feel?
We could move to the TCFD report if you're short of time.
Yes, I think that wouldn't be a bad idea. Yeah, if that's okay, because I think there's a suitable pause there, wasn't there? Yeah, okay, yeah, good idea. So if we move on to item 7, the TCFD report, that'd be super. Thanks.
So the TCFD, as I mentioned before, I don't think we'll need to, or we will talk about it for so long in this section, because fundamentally the climate risk report is built with the TCFD in mind. It does follow the same structure. It follows the governance, the strategy, the risk management, and the metrics and targets of the TCFD. In terms of, I suppose, the governance, there's a few different points that Shropshire have been doing. Again, it ties into, in some way, I suppose, the management quality rating from TPI, that this climate change is being discussed at the board level, that there are ongoing trainings, as was mentioned earlier. And we finish our TCFD report, the governance section, more or less with recommendations just to continue that best practice and to build up on that. Strategy, again, we covered a little bit in the climate risk report. We're looking at the climate scenario analysis presented by Mercer, and let's just double check that as well. I think more or less we're continuing with best practice as well in terms of recognizing those short, medium and long-term risks, both the transition risks and the physical risks. And it was really, I think, worth commending at this stage as well, that Shropshire has a really good recognition of those risks, which may sound clear perhaps, but in the wider scheme of these things, that can be quite rare. So it's worth commending, for sure. Moving on to the risk management, this is all tied up in the climate stewardship plan. The key recommendations to come out of this were to update the plan in line with the changes to the asset allocation that was mentioned earlier. A lot of the companies are now no longer so present in the portfolio, and new companies have come up which perhaps deserve a spot in that plan. So it's a case of continuing to describe what Shropshire Pension Fund is doing in terms of risk management, and then updating it as well as we go with the portfolio. Moving down into metrics and targets, this was covered in quite a lot of detail in the climate risk report. It's really effective what is done in the climate risk report in terms of a broad view over all of the different metrics relating to the portfolio and the climate impact of its funds. So the main recommendation here is to continue producing these climate risk reports. As I mentioned, this is the third report in 2022, and I think the commitment there is to continue annually, and that's fantastic. And yeah, the main takeaway I think was to commend the fund for that big reduction in financed emissions and carbon intensity, and to continue with the best practice that it is incorporating in its reporting and its awareness of climate risk currently. I don't know if Patrick or Basher would like to add anything there.
No, but we're happy to take any questions on the content of the TCFD report.
So,
Yeah, thanks. Can I? That wasn't me. Can I take you to page 129? That's of our pack. Anyway, it's the it's table 4 in the report as at 30th of June. Can you just talk us through when you say benchmark? What does it mean? Quoted blended. Who sets a benchmark which we're looking to achieve? Before you get on to that, I would just like to say thank you for putting in the absolute figures, because it's something that I know I've been knocking on about since I've been on this committee, rather than just the intensity figures, where I dispute with you about the value of that, but we won't go there. If you've got the absolute figures, we have something meaningful, and I'm really grateful for that. So the benchmark on that table 4.
But then the benchmarks are basically the benchmark which the funds are being measured against. So if it's a passive.
Who sets them? That's the question.
So this is the performance benchmark. So when the mandate was established, the performance of the portfolio would be measured against a benchmark, and that was decided by the your advisors, yourselves as a committee, as to which benchmark you would measure performance against. And it's appropriate to do your carbon analysis against that benchmark, because A, it gives you an indication as to whether you're taking more carbon risk than the benchmark, which is, to the extent that this provides you with a risk analysis, that's an important comparison to make. That benchmark also becomes, or is, for all intents and purposes, the investable universe from which the stocks are drawn. And that's why carbon footprinting is generally done between the fund and its benchmark as a comparison.
Okay, so just to go back, maybe I'm just being a bit dim here.
Yeah.
Who sets the benchmark? Is it you guys, Justin, or as part of the investment strategy? Is
The
it?
committee agree it. So when we moved to the Legal and General Low Carbon Fund, the committee agreed to move to that benchmark. So every mandate, the committee it's brought to the committee and they approve it. The manager, the strategy, and the benchmark. So it's agreed here between advisors, officers, and the committee.
And the carbon target benchmark is embedded within that, in what we agreed when we do the investment strategy. Thank you. Thank you very much. That's great.
Okay. Any more questions? That's it, isn't it? Yes. Yeah. Well, we're going to see you again in a little while. Thank you very much for the presentations, because they really have been very interesting indeed. Lots of work has gone into them, and I think we all much appreciate it. We're going to be picking the subjects up later on in page 15, which hopefully we should be there, hopefully maybe in about half an hour's time. Yeah. So thank you all very much, and look forward to seeing you again in a little while. In the meantime, we'll move on to item 8, corporate governance monitoring, and that is Justin, please.
Thank you, Chair. So this is your regular quarterly report on corporate governance monitoring. It's got details in all the appendices about the manager voting at the AGMs. It's got details of all the engagement. It's LGPS Central do on our behalf, Columbia Threadneedle, formerly BMO do on our behalf. It's got updates from Federated Hermes, Legal and General, and stewardship updates. And this time you'll notice as well, Patrick's just mentioned the consultation, TCFD consultation. So that is Shropshire's own response. The deadline to submit that response was the 24th of November. So that response was agreed with LGPS Central and all the other 8 LGPS funds. But it's from Shropshire, this is a response from Shropshire. So that's just in the pack for information. It's positive and we agree with the recommendations. So happy to take any questions on the
Right. Do our representatives at company meetings act on an overall policy that we've laid down, or do they come back if they have concerns about a particular resolution at the AGM to ask for guidance from us? You know, just what degree of monitoring of the resolutions that they oppose or concur with do we put into individual companies rather than an overall blanket policy?
So they act on the fund's behalf. They don't come back to us. They've got a contract with the fund. That meets best practice. So they're the experts in their field in this. So they're acting on behalf of the fund. They've been employed by the fund to act on our behalf.
I do understand that, Justin, but are they acting on a blanket policy, or do they come back if they have doubts or concerns what our view might be on individual companies and resolutions at their AGM?
Yeah, so they act on a blanket policy, but each year they come back. If they've got priorities, they ask all their clients what's the priorities. 10 priorities this year. They survey their clients, so climate is obviously top of our priority. So they come back to us and ask each year, these are our priorities. Do you agree? But yes, it is a blanket policy at the start, but it is reviewed each year.
Okay, thanks very much.
Yes, Lindsay.
How many clients do they kind of like represent?
I haven't got the number. I can find out. But it's clients globally across the world, so they're not just representing Shropshire. So I'm sure it'll be on their websites. You just have a look at their websites, the number of clients. But it's not just LGPS funds. There's no number of clients they represent.
Okay, Simon.
Yeah, I just want to congratulate Legal and General on focusing on deforestation as well, because we talk a lot about climate change, but that is absolutely fundamental. So it's really encouraging to see it.
We've got one recommendation. I can read it out if you like. It's recommendation 2.1. Members are asked to accept the position as set out in the report. Manager voting reports at Appendix A. Columbia Threadneedle Investments Responsible Engagement Overlay Activity Report at Appendix B. LGPS Central Stewardship Update at Appendix C. And Shropshire County Pension Funds DLUHC consultation response regarding TCFD Appendix D. Can I have a proposer, please? Brian, thank you. Seconder, Simon, everyone in agreement? Yep. Okay, thank you very much. Well, we now move on to the Stewardship Code update, and Peter Chedderton is kindly going to take us through that.
Thank you, Chair. Yeah, it was just a very quick paper for the committee. Essentially, back in March, we said that we would be taking the Stewardship Code application by the end of October. Obviously, we passed that date. I didn't actually start in post until the beginning of October. There's probably a good 3 to 6 months work involved in trying to get that. So what I've done here is I've just set out basically our continued commitment to following through that process. Obviously, the timeline's now changed slightly, so we're hoping to be submitted by the end of April. It just sort of covers exactly the same things that you have seen in the previous March report. So it highlights the 12 areas that we need to comply with in terms of the UK Stewardship Code 2020, and it gives you a brief timeline of where we are, the process that we're going to go through in terms of report writing and posting feedback from LGPS Central, and then obviously presentation to yourselves, hopefully at the March committee, to allow us to submit that report by April 23. But as I say, it's purely for noting, but I'm happy to take any questions at this stage.
Any questions? Yes, Brian.
Paragraph 2.4 on the 3rd page. Applying for signatory status is a major undertaking that needs to be repeated annually. What exactly is a major undertaking? Sounds a bit overwhelming. What exactly is involved in a few words, Justin? Sorry, Peter.
It's fine. The actual report itself will probably be roughly about 100 pages in. It's not a case of just us simply going through the 12 principles and saying, yes, we comply with that, yes, we comply with that. For each principle, we have to speak to our investment managers, we have to supply evidence of the actual approach that's been taken, we have to show how we considered each of those particular areas. So effectively, it almost becomes, as you're probably very familiar with, Brian, from an audit perspective, it almost becomes an audit of our process. And it has those same sort of backing papers that it has to go through. So it's not just a case of we can simply do a 2-page report and say, yes, as far as we're concerned, we comply with all of this. This is on our website. We have to actually walk them through step by step. So, and that has to be done every year. So once we've achieved status, that doesn't guarantee us it for the next year. We have to continually show that we're making improvements. So at the moment, as you've seen from the LG Press Central presentation, we're doing a lot of work around the equity portfolios. And that's where the information is at the moment. But of course, there's a lot more to our portfolios and our investments than just the equity side of things. And therefore, it's not just about the equities, it's about how we actually go forward in terms of measuring carbon emissions in things like private equity. How do we measure private infrastructure? How do we measure it on property? So there's an awful lot involved to it in terms of not just setting out how we are, but what the journey is that we're actually trying to achieve to go on, so that we can actually give a full picture across our entire portfolio.
Thank you. Just seems an annual thing sounds very restrictive or demanding. You think we only do the actuarial valuation every 3 years. We're doing this sort of valuation every year with the amount of work that is obviously involved. I'm not sure the game's worth the candle. But anyway, that's by the way. I move the report, Chair.
Okay, we're asked to note it. Thank you very much. We'll move on to item 10, pensions administration monitoring, and over to Debbie, please.
Thank you, Chair. The administration update is providing details on the workloads and performance of the main administration team across the fund. We've given some updates here on communications that have been undertaken with employees and the employers. Quite a lot of employer communication over the last quarter, including the employer meeting that primarily covered their valuation results that Mark mentioned in his update as well. There's some policy updates due to the change in fund structure. So we've given links in there, but the main changes to most of the policies are just regarding those titles. But there are a wider review was just needed in the fund's governance compliance statement and the administration strategy statement, which are both here as appendices and just looking for committee approval. And I'm quite happy to take any questions on any of the items across the report.
Any questions? Roger.
I'll do a quick one. What is Blueprint?
Blueprint is the brand name identifier given to the council's printing department.
Okay.
Simon.
Yeah, no, hopefully pretty quick. I see there's only 45% people who actually access the information available online. Just like a comment about how we can get that up.
Always trying to work on getting it up and as best we can across the industry. That's quite good. So it's not as good as we want it, but actually across engagement. Local Government Association are looking at bringing some national statistics together because there is very little to actually benchmark yourself and know whether you're doing a good job or not. One of the things on our plan is to target areas to try and actually get the engagement up with especially active members, because of course their annual benefit statement is online. Yeah. So what we do need is engagement there, but we work with our employers and offer sessions with that employer as well, trying to engage through their intranets and different ways like that. So we do whatever we can, Simon, but it is a constant on our work plan to try and increase it.
Thank you.
Thank you very much. And I think it's appropriate that we really do acknowledge the enormous amounts of
work and contact our staff have with our pensioners and our deferred pensioners. If you look at page 3, the numbers of telephone calls, the number of incoming posts, 3,000-4,000 pieces of stuff coming in through the post. It's all answered very, very quickly in a very satisfactory manner. And I think as a committee we should take great comfort in that and send our congratulations to the whole team.
Thank you.
Yeah. We've got 3 recommendations, 3.1, 3.2, 3.3. I move all 3 recommendations, seconded by Simon. Everyone in favour? Yeah. Thank you very much indeed. Moving on to item 11, the exclusion of press and public. I move that under paragraph 10.2 of the Council's Access to Information Procedure rules, that the proceedings of the committee in relation to agenda item 12 to 17 shall not be conducted in public on the grounds that they involve the likely disclosure of exempt information as defined by the categories specified against it. I move that. Can I have a seconder? Simon, all those in favour? Thank you.
Just wait for the live stream to end, please.
Are we having a break?
We are going to have a break.